This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the American Monetary Association's podcast, where we explore how monetary policy impacts the real lives of real people and the action steps necessary to preserve wealth and enhance one's lifestyle.
It's my pleasure to welcome Steve Glickman. He is the former senior economic advisor to Barack Obama, co-founder and former CEO and executive director of the Economic Innovation Group. He is the chief architect of the Opportunity Zone program. Steve, welcome. How are you?
Thanks. Doing great.
It's good to have you. Where are you located?
I'm in D.C., but I'm on the road quite a bit these days around the country, trying to figure out what's going on in all these different Opportunity Zone communities.
I understand. So the Opportunity Zone is quite interesting. It's sparked a lot of interest from real estate developers more than investors. You know, it's somewhat complicated for a strict investor. You really have to be willing to do development. How many Opportunity Zones are there around the country?
There are 8,766 Opportunity Zones spread out across every state, 6 U.S. territories, and Washington, D.C.
And when you architected the program, how did you pick the Opportunity Zones? I mean, first of all, that's quite a few of them, and they're little pockets, aren't they? Like, for example, give us a sense of geography and size. What are the largest Opportunity Zones by, square miles, I guess, and then the smallest?
So Opportunity Zones are made up of census tracts. So the size of Opportunity Zones are within a pretty narrow range by population. So they're typically between 2,000 and 8,000 people. And in urban areas, that can be very small. That can be a 1 square block or 2 square blocks or more. But in rural areas, that could be hundreds of miles. So it all depends on what kind of geography you live in the U.S. To sort of get back to the first part of your question, though, lucky for me, I didn't have to pick the zones. The way the legislation was set up was that the federal government set a baseline economic standard, something it calls low-income communities, which are places that are both at 80% of median income of that state or area and have at least a 20% poverty rate. And then it was left up to the governors to pick among those places 25% of those communities as Opportunity Zones. And the net of that is that Opportunity Zones now cover about 11% of the country.
Fantastic. What constitutes, a good opportunity for a real estate developer in one of these zones? I mean, with 8,000 plus zones, how does a real estate developer pick and figure out where to invest?
First of all, I'd say the program is much broader than just real estate. This is a program that you can make investments into any kind of asset class that can essentially,
too, right?
That can essentially take private equity capital. And you're seeing that around the country as well. Now, real estate, of course, is the most active asset class because it, by definition, is geographically or place-based, and because there's a long history of using tax incentives to invest in real estate. The most active part of real estate you've seen in the marketplace has been multifamily, basically investing in apartment buildings around the country. They make up just over half of commercial real estate investments, according to CBRE. But you're also seeing investments in industrial buildings, in manufacturing facilities, and of course in offices. And increasingly, you're seeing this in the business side as well. So we're seeing companies that are using Opportunity Zones to build and finance entertainment companies and film studios, to build renewable energy and telecom infrastructure, and to support franchises and other business models that are sort of organically rooted to place.
And how is the program working out so far? We're in the pretty early stages. I guess maybe the predecessor to that question should be, when did it begin? But then give us an update, if you will.
There are several different, start dates you could refer to. I mean, functionally speaking, we're really still within the first year of the program. Officially, the program was passed into law at the very end of 2017 as part of the largely Republican-passed tax reform. Although Opportunity Zones, its origins are in bipartisan legislation, about half supported by Democrats and Republicans. Governors then selected the actual census tracts in their states that would become Opportunity Zones in June of 2018, of last year. But the Treasury Department didn't write the rules of opportunity zones until really April of this year. They released 2 tranches of regulations last October and this April that make up about 250 pages of regulations. And it was really as of April of this year that you saw the market take off. So we're really just about 6 months into the program. And by the end of this year, I think you'll see a lot more activity. In fact, we've seen quite a bit of activity already. There's some early data that show there are roughly 300 opportunity zone funds in the market that are targeting about $65 billion of capital. And they've raised on average, about 15% of that target. So this program is responsible for roughly in the realm of about $10 billion of equity investment across the country.
Okay, so I mean, those numbers, they sound big, but in terms of the overall real estate game, they're actually pretty small, right? Do you have a projection or a thought in terms of how big this will grow, how much capital will flow into opportunity zones ultimately?
Yes, but let me give you just a sense of context for that $10 billion number.
Right. Yeah, please do. That's always the question, People throw these numbers around and they sound big, but the question is always compared to what? Right?
Yeah. Opportunity zones come out of a long history in this country of doing place-based incentives. And historically, these programs have been quite small. The largest program in this space, and the most recent one, which was now about 20 years old, is called the New Markets Tax Credit. And that program is responsible for about $3.5 billion a year in equity going into these communities. So in the first year of this brand new program, you've seen 3 times as much equity been deployed already. And frankly, that's an incomplete number. That's just one accounting firm's ability to track funds. Much of the opportunity zone investment in this country is being done through single deals, both business and real estate deals around the country. So that number is probably much larger. So I gave you what I think is a very conservative number. I think this program will realistically be in the range of $50 billion a year when it's fully up and running in the next couple years or so. And again, to give you a sense of scale of that, that's about the size of the entire venture capital industry.
Okay, good. You didn't mention, interestingly, because maybe it's obviously a different type of program, but we sure were very involved in the GO Zone. I'm sure you're familiar with that. And sure. I know there was also the Liberty Zone. We weren't involved with that, but the GO Zone, for quite a while, we thought was a pretty great program. Then, as happens with a lot of tax incentive-based things, and I don't want to be political here, but the tax incentive kind of starts to distort the market after a while, and the economics sort of fail to be the reason, that just the pure economics, and then everybody's like, money is flowing for tax benefits, and then things get a little out of whack, ultimately. I just find that to be true over and over again in life. And so the GO Zone stopped being interesting to us in the latter parts of it, but at first, I thought it was pretty great. Any comments on that?
In general, when you look at zone-based programs, the thing that has ultimately made them unsuccessful has been 2 big factors. One, their ability to scale, both geographically and in terms of the types of projects you can do. And 2, has been their flexibility. This program is unique in that it covers such a big part of the country, much of which is still untouched by capital investment in this program. So there are still tons of undervalued assets, the downtowns of entire cities that have now been designated as opportunity zones that can take in billions of dollars of investment in this program. And that doesn't even talk about the business investment sector, where essentially if you move a business or create a new business into an opportunity zone, it now becomes an opportunity zone investable business where, your returns on the course of 10 years can grow tax-free. And so I think the potential here is far more uncapped than any previous example of place-based investing. We know that the total, market of capital gains that you can potentially tap into is $6 trillion, both among individual investors and corporate investors. So you're talking a huge amount of capacity that this program still has to absorb. And, we're never going to get anywhere close to that. So I don't think you'll see the same natural cap in this program as you've seen in other attempts at doing place-based investing.
Right. And I know we've got to wrap it up with your part, and we'll talk to your associate for a few minutes here in a moment. But I kind of intentionally didn't ask you to explain the program, because we've done several episodes on that previously. But, since you are the chief architect of it, I'd probably be remiss to not ask you if you wanted to tell our listeners about some of the highlights of the program or anything like that, or just anything else you want us to know before you go.
Sure. Well, I always find like a little context is helpful in helping to understand why this came about at all. And I'll provide a very shortened version of it. If you believe, for example, climate change is the biggest external problem facing this country, the biggest internal problem is this question around geographic inequality. The fact that for the first time in our recent history, economic growth during an economic recovery has only accumulated in a very small handful of cities in America. And that has huge ramifications for local economies across the country, for health outcomes for people, and ultimately for our economic and political system. This is the first attempt at its type to create an entirely new marketplace out of place-based investing that's designed way different than any other type of program. And it's all tied to appreciation. So this is a program that, to be an investor, it starts with having capital gains. You're able to defer the immediate taxes you owe on having sold a stock or a piece of real estate or a piece of art to have gotten those capital gains. But the really big benefit and the really big value for communities is that it aligns the incentives between investors and communities to invest for a very long period of time. So for investors who stay invested in communities for 10 years or longer, any profits that they see from that investment at the end of that time period, they can earn tax-free. And it's the only part of the tax code that operates that way. It's the only way to get a full step up in your capital gains bill without having to die first, which is a benefit of the program. It's the only way you can go from capital gains in business investment to real estate, or from real estate to business. So it's a very unique and very powerful incentive that's much more akin to like the charitable contribution deduction in its scale than it is to any previous program. And so this is a big experiment right now around the country of whether this can align the long-term strategic interest of communities and their leaders, like mayors and county executives around the country, with investors, and with the need that the federal government has to start to dramatically change the way economic growth is working in America. And I think we're going to get to the scale and the type of activities and the type of communities where we're going to start to see really powerful transformative changes happening around America. But as we mentioned at the beginning, we're in the first inning here, and I think people have to be willing to be patient.
It'll be interesting to see how it plays out, because some skeptics would say that this will just lead to more gentrification as it upgrades these areas, just pushing prices up and affordability down, and pushing the people that ostensibly is to help, pushing them out of the neighborhood again. Kind of, like look at Oakland, California, as all the rich tech money has flown in there. I mean, are there any safeguards against that, or is it going to have that kind of gentrification effect? I mean, gentrification, some people love it, others hate it, right? It depends what side of the economic pie you're on. But just maybe a comment on that before you go.
There are a lot of guardrails, but let me start with, again, the premise here. Most communities across the country and most cities don't look like Oakland. They don't look like the Bay Area. They don't look like Los Angeles or New York. Right. And the Urban Institute, which, studies gentrification very closely, evaluated all of the opportunities in America, and that less than 4% of them are at any near-term risk of gentrification. So this question of gentrification is a problem that very small number of communities face. It doesn't mean communities don't face displacement, but it's much more common for economic distressed areas to see that displacement come from a lack of capital than not too many, because you start to lose your most talented, well-connected, capable people to other cities because there are just no job or business opportunities in your local community. Now, for certain cities, this is a big challenge, and there are the same guardrails you have now, in that the sort of investments that people are really concerned about in the gentrification conversation are ones that are already very closely controlled by local governments through the use of permitting and entitlements and other land use that dictate what kind of real estate projects can go in and what the strings have to be attached to get approved. This program doesn't change any of that. It just provides access to a new form of capital that would have never existed to make a number of projects that were never viable again. And it's really, created to target the places like Detroit and the South Side Chicago and Cincinnati and Cleveland and Birmingham and Erie, Pennsylvania, which are all active in this marketplace, whose downtowns are empty. And they need to start to rebuild these 50-year-old bones into modern communities so that businesses will take stock there and start creating the businesses that will lead to real economic growth.
Yeah, it's really quite interesting. I know we've got to wrap it up, but I'd love to talk with you sometime about how does one sit down and architect a program like this? I mean, just the central planning, if you will, of it is pretty complicated because there are always these intended and unintended consequences to these things, and it's just so hard to determine how things will really play out in real life. I'd love to have you back on the show to just talk about how you take a blank sheet of paper and figure something like this out. It's pretty amazing. It really is. So I got to hand it to you.
Well, I'd be happy to come on. And I would, just to give a really short answer to that question, the way we dealt with that complication, and, it's unclear how well we figured it all out, was by decentralizing the execution of this program as much as possible, putting governors in charge of picking the zones instead of the federal government, empowering investors to decide on what projects they were going to invest in, making it a real marketplace that tied long-term profitability with economic growth in communities. And that's controversial. It's philosophically a real debate between how people view the use of private capital and the role of government in economic development. But I think the one thing that was clear to us is that whatever the government has tried so far hasn't worked. For 50 years, most of the communities we're talking about that are now distressed have been distressed over the last 4 or 5 decades. And we have to try something new. And we're in a place now where government is broke, and you need to tap into all of the success private investors have had in the market and try to engineer a new marketplace where they're naturally making their next investment in some of these places. And it may not work, but creating that decentralized approach is the way we dealt with having to figure out how to solve all of those problems from Washington.
Very interesting, very interesting. Before you go, is there any website you want to give out or anything like that? And we'll talk to your associate.
Peter and I'm sure he'll talk about this a bit more, are working through an entity called Lighthouse.one, which is basically a new approach at tying impact-oriented capital, particularly capital in areas like the Bay Area, which have access to an enormous amount of capital gains, with projects around the country that are able to be transformative in communities. And so we're on the hunt for those projects and those type of investors that share that kind of mindset, that are aligned with the whole goal of why this program was created.
Fantastic. Well, thanks for joining us. We appreciate it.
Happy to come on anytime. Thanks for having me.
Yeah, thanks for joining us.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.